So we're going to revisit our example about the options contract to buy the house. Adam, as the owner of the option contract to buy the house, has the right to buy the underlying, which is the house, at the exercise price of $1 million before the expiration of the contract in 2 years. Bella, as the seller of the contract, has the obligation to sell it to Adam if he chooses to exercise it at those particular terms. And for these rights, Adam pays a premium to Bella, who collects the premium for the obligation. So, how does this apply in the stock market? In the stock market, an options contract to buy shares is known as a call option. And that is what we are going to discuss today. A call option is a contract to buy 100 shares of the underlying company. The buyer of a call option pays a premium and has the right, but not the obligation, to buy 100 shares of the underlying stock at the exercise price by the expiration date. The seller of the call option received the premium and therefore has the obligation, if the buyer exercises the right, to sell 100 shares of the underlying stock at the exercise price by the expiration date. We're going to use an example to see how this works in the stock market. And for this example, let's say there's a stock called Clip. There isn't such a stock, it's fictional, so don't go looking up for it. Let's just say the current price of the stock now is $100 per share. And again, we have Adam from our example. Now, Adam thinks the share price of this company, Clip, will increase. What can Adam do to benefit from that increase? So one thing Adam can do is just to buy 100 shares of the underlying, and at the current price of $100, he would be paying $10,000 for his investment. And then he can just hold the shares. Alternatively, Adam can buy a call option, and this would give him the right, but not the obligation, to buy 100 shares of Clip at the exercise price of $100 by the expiration date. Let's just say, for this example, he buys a 1-year call option. And for this option, he pays a premium, which is a fraction of the cost of buying the underlying. And in this example, the premium is $10 for this option. And so the amount he pays is $1,000. So let's see how this plays out. So in our first scenario, 1 year later, Clip price has increased and it's now selling for $150 per share. If Adam had bought the underlying, he would be holding 100 shares of Clip, and he bought these 100 shares for $100 per share. So his profit will be $5,000 in total. And his initial capital was the $10,000 that he paid to buy the 100 shares at $100. That would give him an investment return of 50%. Now, if Adam had bought the call option instead, today the price is at $150, and Adam has the right to buy it at a much cheaper price of $100. Therefore, Adam would exercise his right and buy the 100 shares at $100. That would give him a profit of $5,000 because today the shares are worth $150 each. So his total profit will be the $5,000. You minus away the price that he paid for the option, and that gives him a total profit of $4,000. However, his initial capital, which he put up for the call option trade, was the $1,000 that he paid for the call option, and this would give him a return of 400% on his capital. If the trade plays out as expected, using the call option can amplify the returns on the same movement in the underlying shares. But what happens if the trade does not play out as expected? Let's look at scenario number 2, whereby the share price actually falls to $50 per share. If Adam had bought the underlying, he would be holding 100 shares of Clip, which he purchased at $100 per share. His loss would be $5,000, and that would be a 50% loss on the initial capital that he put out for this trade. If Adam, however, had chosen to buy the call option instead, because he does not have the obligation to buy the shares, he will not exercise his right. If Adam wanted to buy the shares, it would cost him far less to buy the shares at $50 from the market rather than to exercise the option to buy it at $100. Therefore, his loss would simply be the amount of money that was paid for this call option. However, since $1,000 was the initial capital that was put out for this trade, this would amount to a 100% loss on his capital for this trade. But from an absolute monetary figure, his loss is only $1,000 compared to $5,000 if he had bought the underlying shares. Using a call option can help to limit financial losses on trades. Now remember, a call option is a contract between two parties. So Adam has had to buy the call option from somebody. So now let's take a look at the same call option from the perspective of the option seller. Bella is the seller of the option. When Bella sells the call option to Adam, Bella has the obligation, if Adam exercises his right, to sell 100 shares of the underlying stock at the exercise price of $100 by the expiration date of the option. In this case, it is 1 year. And for this obligation, Bella receives the premium of $1,000 which was paid by Adam. So if we toggle back to our two scenarios, in the first scenario, when the price of Clip has increased to $150 per share, Adam will exercise his right, and Bella must sell the 100 shares of Clip at $100 per share to Adam. If Bella does not have 100 Clip shares already in her portfolio, she must buy them at the market for the current market price at $150 and then sell them to Adam at $100 per share. This would translate to a loss of $5,000. However, since Bella has received the $1,000 in premiums, her total loss on this trade would be $4,000. What about scenario number 2, whereby the share price of Clip has instead fallen to $50 per share? Adam will not exercise his right. Bella will not need to sell Clip shares to Adam at $100. Bella's total gain is the premium of $1,000 which she collected. So once again, to summarize, a call option is a contract to buy 100 shares of the underlying stock. The buyer of the call option pays a premium for the right, but not the obligation, to buy 100 shares of underlying stock at the exercise price by the expiration date. The seller of the call option is paid a premium and therefore has the obligation, if the buyer exercises the right, and the seller of the call option would have to sell 100 shares of the underlying stock at the exercise price by the expiration date to the buyer of the call option. We also saw in the two scenarios, when the price of the underlying is above the strike price at expiration, the buyer of the call option can exercise the right to buy the underlying at the strike price, which is cheaper than the current market price. The seller of the call option will be obligated to sell the shares to the buyer at the strike price, which is lower than the current market price. In light of that, the investment return of the buyer of the call option can be infinite because there is no limit to how high the share price can go. Likewise, the seller of the call option in theory may incur infinite losses as they may have to go to the market to buy really expensive underlying shares in order to sell to the buyer of the option at the strike price. In scenario 2, where the market price of the underlying is below the strike price of the call option, the buyer of the call option will not exercise the right as he can simply buy the shares at a much lower price in the market. Therefore, there will be no action needed on the seller of the call option as the buyer will not exercise his right. The maximum loss of the buyer of the call option will simply be the premium that the buyer has paid for the option. And as for the seller, the maximum return will be capped at the premium received for the call option. Lastly, let's take a look at the benefits and drawbacks of using call options from both the buyer and the seller's perspective. The initial capital outlay for the buyer of the call option is much lower. Hence, the buyer of the call option can enjoy much higher percentage returns on his capital if the price of the underlying shares increase above the strike price of the option. His maximum loss will be capped at the premium paid for the option contract. The seller of the call option can create an income stream from collecting premiums on selling call options. This can be a very effective and lucrative income generating strategy when used in combination with other options or with other positions in the underlying asset. We will talk more about these strategies in other videos. The drawback of selling call options is that losses can theoretically be infinite. The seller of the call option may have to acquire really expensive underlying stocks from the market in order to fulfill the obligation to sell them to the buyer of the call option at the exercise price. Okay, I hope that this video has given you a good overview into the basics of what are call options in equity markets and how they work. If this video has been helpful for you, please leave a like or subscribe to the channel. And if you have any comments or feedback, please leave them in the comment section below.